Okay, let's get this show on the road. Well, there you are. Some of these numbers, I'd strongly encourage everybody to keep this slideshow. Don't use it to light your barbecue or fire, because you probably are not going to see these sorts of numbers again for quite a while. Although we hope we do. But the first important stats there: 70% of results have beaten expectations. So this is not the previous year's results. This is expectations. This is broker estimates. Phenomenal, absolutely just phenomenal. The next one there, 80% have increased their earnings, 75% have increased their dividends. The only other stat that was of interest, and it's probably because of COVID and Xi Deng and a few of the other fellas that are running the country, there was less guidance this year than normally is the case, but we can understand why. We see that as a positive, and we'll come back to that point when we do the thematics. But in the blue there, those beautiful Geelong and white colours there are there for you, Rascal. 40% profit growth, unprecedented, never happened in our lifetime, or at least in mine, as I said, 37, 38 years, predominantly led by resources and the banks. And we've had the incredible run of iron ore. We've seen it now pull back from the 220 tonne an ounce back down to about the 160, 170 level. Just as an interest there, I'd get everybody to write this number down. The federal government in the budget has iron ore at $55 a tonne. $55 a tonne, and so above 55 a tonne, Australia's doing pretty well, as are our miners. Even if at current prices at 160, where it's pulled back on, these are astronomical margins that are being made, and we can't see that changing for the foreseeable future. But we'll take some more questions on that. So these stats that you're looking at there, these once in a lifetime stats that you're looking at there, is in the backdrop of us coming in and out of lockdown. It's in the backdrop of us not being able to travel, go to a pub, have a bet, or do any other things, like simple thing like even going to a football match. So you think to yourself, well, gee, how good could it be if we start to open up? So what our market has done is looked through the doom and gloom and said, well, this is a finite situation that we're dealing with. We don't know the exact date, but it is finite. And now the premiers are starting to get on board, and it's the buzzwords now are 70 and 80, 70 and 80, 70 and 80. And so you can sense that they're now on board. So what has happened in the last 12 months is that the consumer, along with the government, has spent our way to this level of glory. But JobKeeper, quantitative easing and low interest rates have also underpinned this. JobKeeper has now finished. Quantitative easing is still there and will be used, as will interest rates. So I'll jump ahead. We don't see this thematic changing greatly between now and the next, or at least now through till Christmas, and most likely into the full-year results in 2022, which we've just started the new financial year. This is just for a half, 30 billion plus in dividends. Phenomenal. There's cash that's going to come back into the market. There's a couple other slides further on which make this number look incredibly small. And so when the bears are getting depressed about it's all over and it's shocking, like being a Geelong supporter at the moment, just remember the sheer volume of money that's sitting on the sidelines. And we'll come back to this when we come to the thematic. So don't get depressed. Cash is king, and bingo, have a look at that for a number there. This is a huge boost, as it says there, for retailers and yield stocks. And this is what's been happening and is unlikely to change, as I said, between now and Christmas and running into June next year. These are just half-yearly numbers. That Wesfarmers one is actually, you can write this down, ladies and gentlemen, is actually 2.6 just a snapshot of the larger ones. The big advantage here, the big advantage with this page is that you've got to add franking on top of that. Now, there's a lot of financial advisors and tuning in on that, and you can speak to them about how beautiful that is. But when you put another 25 to 30% win on franking on top of this, life's a pretty good thing at the moment. So this is the other big one. The CBA has announced the buyback and the passing on of franking credits. So here's another 30 plus bill, and this is just a few that have come out that's coming into the market. Once again, enormous dollars that are coming through and just continually going to underpin our market. On a statistic that I want everybody to write down, because you probably never see this again in your lifetime, but there's about $86 billion of funds that are going to hit our market between now and Christmas. And just as an aside, write this down as well. That's 5% of Australia's GDP in cold hard flooding our markets one way or the other. 31 billion of it in dividends, 34 billion is in takeovers, cash takeovers, and 21 billion is in buybacks. Phenomenal. As I said, just extraordinary numbers we're telling. Okay. Now, this is where we have some fun. Market outlook. Where are we going to go? So capital markets, along with the RBA, appear to be looking through, as I said, this lockdown and the misery that we're all living through. No golf and football. But as I said, this is finite, and markets price themselves in expectation rather than realisation. There's nothing new that's happened or that's gone on in the past that is likely to occur into the future. And so 2/3 of our market has now started to move up. You'll have heard a lot of commentary that people say, oh, it's overpriced, it's overpriced, it's overpriced. It possibly is in maybe 2 or possibly 3 sectors, but there is another third that hasn't moved yet. And as I said, Austin will touch on that in a second. The markets had bumper results and dividends amid low interest rates. Now, with low interest rates, I gather everybody that's on this screen is screaming blue murder. You've got cash rates at 10 basis points. If you walk into your bank and you've got $1 million bank bill, if you're getting 15 or 16 basis points, come tax, no growth, you've done well. Equity markets, whether we like it or not, is the place to be. Where you're picking up 5 and 6% fully franked on very risky things like ANZ and Woolworths and Wesfarmers. If that's your underlying asset, but that's what you're getting paid, I think you can afford to take that risk and take that risk for the foreseeable future. The VAX rates are booming. The markets are pricing this in. This comes back to looking through where we're at, what's going to be on the other side. I think we can now see it and touch it. The other thing that is quite significant is house prices and house construction is going to continue well into 2022, totally underpinned by where interest rates are and where unemployment's going. So you would have thought through all of this gloom and doom, unemployment would be where it's at. Participation rates never been any better. Now they jig around with those numbers, but by and large, it's they're all very, very positive. We do not see that that's going to change either for the next 3 to 6 months and going into the new financial year. The best sectors, well, they were pretty simple. This was discretionary retail. So the online has had a boom. There's been more sales of flat screen TVs and home office equipment that you could poke a stick at. The question now is this going to be the spend going forward? I mean, how many times can you redo your home office and buy possibly unnecessary equipment for your house? So we saw a lot of stocks, and Wesfarmers probably spoke about this in their results. JB Hi-Fi did it as well. Kogan was another one. So what's going to replace that discretionary spend? We'll tell you on the next slide where we think that's going to be. But we will see a shift in spend coming into next year. Healthcare, obviously, the fear of what's been going on has helped drive those stocks. We don't see that that's going to change. And financial services have done very, very well. The banks have led the way. They are in very, very good shape, and we don't see that that's going to change at all. Resources has also been the backstop of the Australian economy. We do not see that changing. For all of the noise with China, the iron ore is pretty well irreplaceable. Vale is the only competitor, is at least 18 months to 2 years away, getting back to about 20 to 25% of their capacity. That's 18 months to 2 years to just get back to 25% of their capacity. There's noise that I think it's Guyana, that the Chinese, don't quote me on that one, but they're spending a mountain of money on an iron ore resource. That doesn't come on stream for another 5 or 6 years. So Melbourne probably would have won a couple of premierships by then. So I wouldn't get too fussed about that. The tech sector was the boom. We saw Australia's largest ever merger and takeover with APT and Square. We didn't feature there because we don't buy these types of stocks for these types of funds, because we're an income fund. And these companies don't pay a lot of dividend at all. But it is good for Australia to see. I sort of touched on the China relationship. Still got a fair way, a bit more to play out. Interestingly, we're a substantial shareholder in Treasury Wines in the fund, and they were one of the stocks that really got knocked around when they decided to stop buying our wine. They fell from about $13 or $14 down to about $8 or $9, and they're now virtually back to that same price. So that's a good example of avoiding the noise and not getting caught up in it, and realizing that the quality of the asset that's inside of Treasury is pretty significant, and it is being able to find replacement markets, not as quickly as it would have liked, but it has certainly made great strengths going forward. And it is probably one of the stocks that we're tipping that sadly could be under a takeover threat next year. We touched on the iron ore price. The other interesting thing to remember there, the miners are producing to produce and ship it at about $24 to $28 a tonne. So they're making a lot of good hay there while the sun is shining. So don't get too concerned about the iron ores. EV is the big sector. We're building a portfolio of stocks to take exposure to that. And we probably might even take a question or two on that one later on. We've commented about the RBA. They will continue tapering, as they will in the US. They're not going to allow this markets to tip. We draw your attention to the interest rates where they are. The 10-year bond is at 1.2, 1.3%. Can you believe that in your lifetime? Unbelievable. And we don't see that that's going to change for a while. Yes, the bogey of inflation is running around, and some of us on this Zoom might think, gee, bring it on. Let's get some asset price pressure happening outside of houses. So it may not necessarily be a bad thing. Back to the sheer volume of cash that's in the market, our advice and what we're practicing here at Armytage is to buy the dip. If there's any ever sell-offs or panic that hits markets here and there, buy the dip. Just the tsunami of money that's in this economy is unprecedented. Finally, just on house price, everybody, it's a big talking point. It's now cheaper in my lifetime to pay off a loan than pay rent. Once again, the interest rate thing. We don't see this changing, and it's underpinned by employment. Immigration used to be the big driver of house prices. We haven't had immigration here for the last couple of years. So we say, Armytage says to its clients, well, if we did see immigration in 23 or 24, is that going to underpin construction again? Well, we don't know yet, but it's highly likely that it possibly could. Maybe not to the extent that we're seeing today, but it certainly could. So we do forget about immigration. And as I said, unemployment is pretty well underpinning our whole market. All of that is governed by one thing, and it's called politics. How politics has changed. So if you feed that into our market, along with the cash, I think we're in a pretty good state. I think we're in a pretty good state going forward with that. Brock, over to you.
Yeah, thanks, Lee. So, I mean, we go down to the just a little bit of history about Armytage. We're established in 1995, so I recently turned 26 this year, which makes us the oldest independent fund manager in Australia, which says something about our business. You know, anyone can come in and make a quick buck from here to there, especially in boom markets, but to be able to last as long as we've lasted with our track record just goes to show you the type of people we have at the shop, and that our strategy and our discipline to stay true to label works. So in terms of our two, I guess, our main flagship funds, we have an Australian equity income fund, which we started in 2007, which focuses purely on the top end of the market, the ASX 100. So those big, boring blue chip stocks, and we pay a quarterly distribution, whereas our other flagship fund, the Strategic Opportunities Fund, which was started a couple of years before the Income Fund in 2005, which takes a broader view of the market. We look at the All Ordinaries, so a lot of those companies that are in the ASX 100 we include, but we have the option of going a bit wider in terms of those, you know, smaller to medium, mid-cap stocks, and a distribution that plays semi-annually. So if you look at the performance numbers there, I mean, you know, recently, the last year, I mean, we are in a raging bull market, given where the Fed sits with rates are at near zero. So performance is pretty good. But if you go out longer, if you go at mainly the 5-year performance per annum, I mean, you look at ASOF, you know, it's producing 11.5% capital growth every year, and the Australian Equity Income Fund 9.4%. And you look at those numbers since inception. I mean, producing those types of numbers on a consistent basis just goes to show you, as I said before, how disciplined we are, how we remain true to label. I mean, these are funds that are, you know, you put your money in, they're blue chip stocks that you can go to bed at night and sleep comfortably, low risk capital preservation. Looking forward to replicate dividend distributions with an overlay of those options trading strategies, which add a bit more, I guess, income and performance to the fund and protect us on the downside as well. So certainly from my perspective, you know, if you are at that stage of your lifestyle where you're looking to create a bit of a steady, regular income stream because you're a self-funded retiree, an Australian Equity Income Fund will certainly be right in your wheelhouse, given that you're getting a nice capital return over a long term. But if you look at the dividend stream and our distribution history, I mean, you look at that going back to FY13, our gross yield net of fees, I mean, 8%, above 8%, like clockwork, and that's because
put it up.
We stay true to label. I mean, any reputable investor will tell you that you know, the key to making consistent returns over the long term is remaining true to your form, staying disciplined, removing all emotion from your investment decisions, which you know, as we see, there are two things that drive the market: greed and fear. But we remove all of our emotion from our investing decisions, and we remain true to label. And that's why we can get those consistent dividend yields that we produce, certainly from an income perspective in the income fund and ASOF as well. I mean, if you're probably at that accumulation phase of your investment time cycle, you know, again, consistently above 8%. I mean, the only year we were below 8% was in FY20, and that was only 0.18 below 8%. So you're getting a really nice blend of income through the dividends, and you're getting a nice capital return on your investment as well of above 11% since inception. So, to give you a snapshot, if you sort of reinvest all of those capital returns and dividend yields that you're getting on a yearly basis, you're looking to double, your initial investment monies every sort of 5 to 7 years. If you are interested in learning more about our products or learning more about any of our funds, please get my details from Russell. We relay what we're thinking about, what we're talking about on a weekly basis, to get you behind that sort of curtain to make you feel like you're part of the firm, and we really value our clients.